Trading the foreign exchange market carries high risk and may not be suitable for all investors. Trading on margin, utilizing leverage can carry an even higher level of risk that can lead to a complete loss of investment funds. So before deciding to trade the foreign exchange market or using any of our software alert products, you should carefully and diligently consider your personal investment objectives, level of experience, and risk tolerance. There is a possibility that you could potentially sustain significant loss. You should not invest any capital or trade that you cannot afford to lose. It is your responsibility to be aware of and understand all risks associated with foreign exchange trading and to seek professional advice from an independent certified financial advisor if you have any doubts. Auvoria Prime does not exercise trading authority over your trades. You and you alone exercise discretionary trading authority over every trade.
My name is Steve Federal. Hopefully you can hear me loud and clear. Been on client calls, so I have not had the ability to log in and get this started at 10 a.m., which typically happens. So I appreciate everybody bearing with me. Hopefully you can see my screen, see my ugly face, hear me okay. Let's get started. Yeah, I get so many different tabs here. It's bananas. All right, forexfactory.com. The filter always needs to have these two folders removed, in my opinion. July 18th was Sunday. We're working on the week July 24th. Do keep in mind we have some new subscribers on the call, looks like, so welcome everybody. I could tell you guys for a simple fact that a lot of the trading rooms that we're going to be setting up and have already been running have been doing really quite well. So the Hawkeye group, Arrow group, in both the products they trade, as well as the beta of our new either partially or fully automated EA from our Israeli developer has been doing really well. We're trading it on gold and a bunch of other currencies as well. So do keep in mind, I have been noticing the questions that I've gotten in relation to some of the Arrow stuff. A lot of the guys in the Arrow room are beginning to trade a lot of different indices. So I think what I'm probably going to do in my weekly calls is maybe address the indices a little more specifically. But the Q&A window's open if you guys have any questions, if there's anything you want me to specifically address. I mean, no surprise that we had a huge sell-off the other day and almost all assets got taken down with it. And then obviously you saw a flight to safety, if you will, into the treasuries and to a lesser degree some of the currency markets. So a lot of that was due to just this Delta variant, which I don't see the big deal, but all of the alarmists and Karens out there feel the need to be alarmists and Karens. So we'll just leave it at that. But from the person that spends most of his time trying to figure out who's full of BS and who isn't, whether CEOs, investors, analysts, right, central banks, my job essentially is to weed through all the crap and help get some clarity to reduce risk management and make analysis more mechanical. So with that being said, just going in here, monetary policy minutes, that was, yesterday, nothing really earth-shattering came out of this. Nothing really earth-shattering came out of these OPEC meetings. A lot of what gets disclosed here in relation to the oil markets globally, you'll never ever read because it's talked about in secret. But obviously the oil-producing countries, which comprise a huge chunk of the Middle East, they want to pin oil at a certain price per barrel. They'll never tell you what that is, but typically it's somewhere in the area of $60, $70 a barrel. Anything over that, the pressure comes down on them like a ton of bricks. And anything under than that is typically not as profitable. So that's the best thing I can say as far as OPEC. Tomorrow, both Wednesday and Thursday, there's holidays. Do keep in mind as we move over, seeing a big rally in equities again today. So just make this screen bigger. Actually, just remember that the ECB press conference is tomorrow, not tomorrow, but Thursday. Today's Tuesday. Nothing going on today. All right, moving over here. Let's get a better view. There we go. Each, let me look at the spiders here, just so we're looking at this correctly. Got all the averages, as well as the Bollinger Bands on this. So we had, why does this not look the same as yesterday? That looks better. So here's what we saw yesterday in the S&P. I know there's some that are trading NAS and S&P. But either way, so it's been, I don't know what, June, a little more than a month, right, before we've had a decent correction that's come back and touched any of these moving averages. So we touched essentially the 50-day right here, bounced off, and now we're having a big reverse because I think the market has, was a little levered here and baby out with the bathwater, and now I think everybody's getting more clearance that this Delta variant may or may not actually have disruptive capabilities in the pandemic reemergence, if you will. Let's hope I'm not wrong with that statement, but from what I've read and a couple of my infectious disease docs who think Fauci's an idiot have a completely different opinion of how this whole thing should have played out the last year. They don't see it as an issue. In any case, we could be wrong. So let's look at the NASDAQ. Same thing. Touched a much shorter moving average. Now this is the 20-day line here, brown, and bounced off that again. I think ultimately we're probably going to see the final leg of a rally into Q3. Could be wrong, and then I think that'll probably be it for maybe about a year and see a pretty decent correction. So we'll have to see as time progresses if that longer term prognostication comes to fruition, or if I'm just totally full of crap. Let's see. One question on the NASDAQ is I typically look at daily charts. They don't really have any support and resistance points up here other than this 14,202 area. But if you're following the Qs, which is sort of the other way to do it, there's nothing up here as far as we're up in nosebleed section if you just look at the grand scheme of things. So what I'll try to do is look at the data just in a tight window with this market profile on the side. You can see how, maybe not, let's try this. You can see how the center line of volume trading was right around this 354 area. For the question I just got. All right. Do keep in mind what's been going on in the treasury markets. It's been a little bit disruptive. But as far as the movements and the dollar, again, over this period of time, any weakness, you have a flight to the dollar, and you typically have a flight to bonds, the longer term nature. So you can see in this 20-year chart, at a real flight, right? Oops, I'm kind of moving the screen around too much, but I'm just trying to get a feel for. Let me just turn some of these off. These are kind of bogging us down here. There you go. There's a little more of a purist view. You can see how this concern about inflation has just ripped us up into this area and or flight to safety. And all this really means is that, when equities are weak, money has a tendency to move into the bond or the credit or fixed markets, as some will refer to it. But now we're seeing a complete reversal of this, obviously, because we're seeing a rally in equities. So, but just understand, kind of just touching briefly on that and how that relates to the dollar. DXY daily chart here. Just trying to keep it clean. We're having, looks like we're pulling under here, and we had at this 93 area, this line actually just recently showed up. So if we stay under this, there's actually a pretty good chance from a resistance standpoint, we maybe continue to coil inside these areas, which really just means, as far as if you're accepting trades on NAV versions or you want to keep a closer eye on broader markets, we may spend some time balancing in this very tight area, which is essentially properties of a coiling type of market. Been talking a lot more about some of the newer introductions I've made on these calls over the last few weeks. Is the question I just got on the market profile and the volume profile chart on the left-hand side, bell curve. I've gotten into that a lot on my Telegram channel. There's a whole educational piece you can download in there on it. It's actually a really good piece that hopefully cuts through the crap in about 4 pages of explaining why this indicator is used tremendously by professional and institutional traders, as well as big time traders of all natures. Euro US dollar, obviously this is the opposite of generally the opposite of the chart we just saw, the whole move up. So when that line showed up for resistance, notice the line also showed up with the same parameters as support. So maybe this caps off the move for a little bit. Who knows? Maybe inflation numbers come out again into next week, and the following week we'll see some more numbers being released globally, and it continues to fuel these fears, and then you have a continued lift in the dollar. But we're really getting up on the dollar index right against this, what I consider to be truly the line in the sand right here, which is almost pretty much the center point of the whole previous balance area and the fractal high, the last top here at the 93.40ish area. So keep in mind we'll come up against that. We got a little bit of a hurdle. Looks like good before we can go up and test that area, which is essentially 50 cents higher. And you really want to see how that's going to react, which is absolutely going to correspond to all of these lower levels right here. This whole 1700-ish area. So just keep that in mind. Pound kind of looking similar, but if you see I toggle between both of these, notice it's made its first peak underneath this area since 8th of February. Can't even argue we've been all the way back to the 4th of February. Back into this previous area of balance and or coiling before we flew out of it. Had a sort of little crescendo top on some pretty decent vol, and then we built a base again. So this actually could break slightly from the euro US dollar pair we looked at here. Just a quick toggle between the two if you weren't paying attention. You see we're poking down below. CAD JPY, let's take a look at that as well. Again, this daily chart, each of these represents a single day as far as a candle. This will be a little easier to see. Big support here at the 85.67 area from the perspective of support. Even though red line may not show up or whatever type of support you've drawn, the bottom line is we had a quick reaction off of that and reversed back up. So the more than likely the first time we get down against an area like that, provided, again, this is a great example of a pin action type of currency pair in relation to others. So, before you sort of put the story together with this, what I try and do is look to see what's going on with US CAD, right? Again, this is that, flight to safety, if you will. And now it's being reversed as equities are going back up. So that trade's putting some pressure, obviously, on this one right here. Okay. So that's why I always think it's important. And, obviously, a lot of the correlations or uncorrelated markets, won't always be in lockstep with each other. But, you can pretty much understand if there's a major deleveraging going on in a really ridiculously bubblicious equities market that needs more than a 10% correction or more, in my opinion, to truly be shaking the weak hands out. It's going to spill over into currencies and certainly precious metals in the credit markets as well. So why I oftentimes will start analyses off with what's going on equities globally, maybe looking at bringing in as well a couple of the big European S&P 500 type indexes, Euro stocks, and some of the other ones. I'll put those in the list here coming up so we can begin to take a look at what the DAX is doing, right, which is a little more representative of S&P. But I prefer sort of the Euro indexes that capitalistically weight equities, companies like Unilever, BMW, all of them in an aggregate of about 2 or 3 to 500. There's different indexes that essentially accomplish that diversification, just like the S&P 500 does. But this is somewhat of a myopic view because we're just looking at companies in this country. So as I'm expanding out my research for everybody, and I'll start putting some of the bigger foreign indexes in. For the question I just got on emerging markets, this is more equity based. This is really only because this thing is super liquid and it's iShares. Again, iShares is one of the biggest investment banks on the planet, for that matter. This is the emerging markets fund. So I pay attention to this, not to Russia or India or China, maybe a little bit of Shanghai, but I don't pay as much attention to the Brazilian markets. And essentially, this index is made up of the BRIC countries primarily. So that's Brazil, Russia, India, China, and then it has some tertiary index exposure to some more. But essentially, this is like the third world markets, right? Capped by the big four, China being the obvious largest. But I just pay attention to this as far as equities. I don't really get into breaking those other indexes down. Let's see what else I want to say about CAD. Move on. Let's take a look at the weekly on this dog. And you can see where all the support is. You can see where we broke trend. And this is fairly hard support from a weekly perspective down here at 84. So if the yen's going to continue to gain strength against Canadian dollar, I would expect, this is provided obviously the US dollar continues rally, we'd see this 84 area, 84.50-ish. Look to this zone first, which also just happens to have a whole bunch of other stuff lining up in this area. So this whole 84-ish to 84.5 should be some pretty big support on this longer term. Euro GBP, go back to daily. Very defined market. Very serious resistance there for the question I just got at 87. Big support down here at 85. Right in this little zone right here. Euro CAD, same thing. Weakness in the Canadian markets. Also their stock markets, obviously, yesterday. Leads to a big rally into other currencies, typically in relation to markets that get hit the best. I should say the worst. Best isn't necessarily worst. GBP CAD, here is our NEO trade. Big rip. I actually didn't pay too much attention to how this did in terms of the software. You know, maybe most of these movements came when it wasn't trading. I forget the. So we saw all this take place in a even arguably 5-hour period of time. Also, US, not much effects on some effects. It broke through a pretty important support area here. I wanted to make a note of that. Right at the 74-ish area, made a break of that. And really, I don't see support for at least a whole bunch more pips down. 72.80-ish area to 73.10-ish area. That's the zone of support from the previous moves and where our launch point was up into this newer base that we've built inside the topping kind of head and shoulder-ish looking. By the way, we've already broken the neckline, essentially right in here. More of a sloppy head and shoulders, but still we broke it. See this rejection reverse right here, this candle. This told you that we got rejected big. Somebody's defending that level now because it became resistance after was one support, which is usually a great test for the fact we're going to move lower. So a lot of the swing traders would see this test all the way up higher and the quick rejection within it during the day. And then we ended lower. You could actually stay short for a few days and your stops are, essentially halfway through this point. So we never even got a 50% retrace right here. That's how you know it's going to be heading lower. You can really only play these patterns out, with maybe 10 to 20 days of this. Anything beyond that, you're really sort of pushing it statistically. But when you see the reversal, your biggest money is always made in the next couple of days. This is a test higher. It's kind of like a spinning top. If it was an island reversal, which means there would have been a green candle gapping up, or an engulfer, would have foretell the same things, that further weakness was ahead. Provided the U.S. dollar keeps rallying. So this is all sort of an inflation trade right here. But there's been cues to see kind of how you can play this out. What else? GBP, right? So we're essentially back inside of this 7,400-ish area. Gold spot. Yeah, I don't really have. We've seen how sensitive this damn thing's been to any whiffs of inflation. So, be a tough allocation I would have to have inside of client accounts of anything more than a few percentage points. We used to be much heavier on this rally, but we've lightened up because we just don't like this price action. You want to continue to see it going higher, but it's going to be it's like slogging through mud and running a 10K because you're just constant concerns of inflation in the marketplace. It's going to be an issue here. But ultimately, I think if we can get past all of that, see some smooth sailing. I mean, still ultimately the target for this thing is the all-time high right here. I should say the recent high. It's the 7th of August. We're coming up on a year ago's recent high. And then here's the monthly, which I think is another important one you always want to look at when it's coming to gold. And surprisingly enough, even though I don't have the volume profile chart on this, we can certainly look at that. One of the key things of gold is that you have, at least with the gold bugs, as we call them out there, and that's, Uncle Frank, who stores, $20,000 in cash and has a whole collection of guns in his safe. And he's always talking about the end of the world, right? And that's the kind of guy that's like the big time long holder in gold. Those are the kind of guys that are actually still holding. And, for many, many, in this case, over a decade that we've spent time, notice, inside this. So I always laugh because when you see all the shows, some cases infomercials, some cases commercials on financial TV, they're all touting this. Actually, screw that. They're touting this. They're touting this move from, by the way, this was when the tech wreck happened, right? And things were just crap in tech, and you had just a huge move in gold from the 1st of August, which was approximately the peak. Yeah, essentially the fall of 11 was the peak, but you had this run. This is the performance that a lot of them are showing. What they don't show you is the subsets of, if you had bought the damn thing in the craziness of the late 80s, and you held it the whole period of time, you essentially hold this commodity for like over 20 years. You never made a dime, right? Never even came back to the price. So what they don't tell you is that there is, in some cases, ridiculously long periods of time where commodities will spend, especially gold. This is exceptionally easy to illustrate. Let me show you this chart in a bigger. So you get a better feel for the entire move. This is always something like these kind of commodities. And I don't know what this amalgamation of volume is right here. It seems kind of odd, but whatever. Maybe that's when we stop the reserves and In any case, the point I'm just trying to make is that if you always look at performance just based on some period of time, I personally prefer to break the period of time down, just looking at, in this case, monthly candles of the last 40 years in gold we're looking at right here. So it's a big tell as to, we've had a good rally. So don't let any financial experts, if they're actually experts or even watching, most of these guys are just idiots. I'll just pay attention to the good and the bad. What they aren't telling you is that, had you been one of the knuckleheads that bought at the peak at 1875, you watched your investment drop 30%, some cases 35, only to finally get back to par, if you will, 10 years later. Right? So you even made a dime in 10 years, but you could have been invested in other areas. This is why I'm far more an advocator of a long base playing out. And then we break the base. And you notice we never come back down. And these are monthly candles, obviously, but just longer term swing. We broke out, came back and tested again, couldn't get lower, right? Told you we were headed higher. And this is really when you want to be a buyer of any asset class from a long-term perspective and be a holder for, in this case, many years. Now we just had a lot of volatility from monthly chart. It's very difficult to read into. You have to switch over to a weekly chart to get a better feel for how solid this 1950 area is. Ultimately, I still think we need to go up and test that area, in which case we'll be lightening up in client allocations, probably 1.5%, 2% from current allocations when we get up to this area. But it's just, this thing's just been a real bitch to make money in. So we move on. Let's look at the coinage. No surprise. We've been reading the tea leaves on this one with you guys for a while. We're hanging on the edge. Thank you, John. Appreciate it. Hanging on the edge. This is possible we could actually see a waterfall moment on this one. I think there's a lot of people. I always love that acronym, HODL, holding on for dear life, which should absolutely not even be in your lexicon. Just remove it from your vernacular, because this is not a risk management type of statement. It's a statement that I'm too stupid, so I'll just hold on for dear life while this moves all over the place on me. In some cases, if I put way too much of my wealth in it, it's going to evaporate and or eradicate me wealth, right? Not a risk management move you want to be reciting to oneself. So I had a friend of me the other day say this to me, and I basically lambasted his ass at the brewery so that he completely removed that from his brain. It's not a risk management technique. It's a lazy ass technique built by all of these shills that have been pushing coins of all kinds of coins, just using the fact that Bitcoin's had, in some cases 80 or 90% returns, or 80 or 90% pullbacks in its life. So if that in fact is the case, then a risk manager would say something like the following: okay, well, if that in fact is the case and you expect that to continue, which is a reasonable assumption, right? Then wait for it to do one of those major retracements and then buy some. Don't buy a lot, right? Make sure you can use money you can afford to lose. Then if it goes back up now to, the whole 64-ish a coin it got damn near in this peak, take some off the table again, right? Wait for another big fat correction, which more than likely will come. So, I mean, it's been the case over, it's not really exemplified on a daily, but if we look at a weekly chart of the coin, right, where was your buy point? It's basically the end of last year. See how we finally cleared this point, new all-time highs. So all the sellers were finished, arguably, at this period. And, obviously we had mania, this and that, starting right around the beginning of December. Most of it was just a rally back out of the pandemic. But, this is always the time you want to catch anything coming out of a long basing pattern and ready to break out. You can even look at it on a monthly chart if you want to see essentially where you want to be in this trade, right? This was a very good base that played out through multi years, meaning that every time we rallied, all the folks holding from much higher levels had a much better chance, or at least back to break even. Remember, that's that psychological mindset. For those that have not heard me talk about this, there's been multiple Nobel Prizes awarded that have shaped financial theory. And without cutting through all the gobbledygook of that, it basically tells us that the human brain hates losses 2.5 times more than they like gains, right? And I can tell you this unequivocally is true, even if I didn't believe the research, just dealing with clients for 20 plus years, right? They don't care in most cases whether you make them 8, 10, 20%, 30% on their money, right? They just don't want you to lose 30%. So they'd rather take 8 all day long and not lose a whole bunch more, right? And the same thing's the case with breakouts. Because a lot of people are like, why they gotta wait all the way to this whole breakout? Because the point is that when you buy on a breakout, if it's done correctly, that's a big if, you have no sellers in front of you. So that means that any asset can do nothing but go up, right? Pause, certainly can retrace a little bit. But in a broader sense, in a general theme, it really can do nothing. I guess if you guys are looking at me this way, the chart, you have a basing pattern that plays out and then it breaks out to the upside. Why does it break out and run? Well, there's a lot of good things. Maybe the company's making a ton more money, right? Maybe they've merged and have a whole new asset class in terms of earnings that they can sort of merge together, or have a completely accretive balance sheet in terms of earnings, right? But essentially the point is you don't have any sellers in front of you. It's just that simple. That's why I'm constantly talking about breakouts. And yes, with breakouts, you will be buying at higher prices. And that's what mentally a lot of people can't get past, right? They say, well, why don't you just buy down here? Well, the point is that in hindsight, this is that Monday morning armchair quarterback crap, right? Everybody's hindsight's always 20/20. Yeah, how did you know that when you were buying here, that a damn thing wasn't going back to, instead of 4,500, a coin wasn't dropping to 1,100, right? You just didn't know. But the point is once you finally got to a point where, which essentially is right here around this 20,000 mark, that's why I'm looking for this to be the retrace point, quite frankly, because it was the previous high. You'll see a bunch of buyers probably step in from an institutional level and do some buying. Who knows? Maybe Elon and some of the other shills will come out and talk about this again. But ideally, just knowing this currency is going to probably suffer some huge hits, look for the hits to be a buyer. And then keep in mind, there's nothing wrong. Let me go to the weekly and to illustrate this point. There is nothing wrong. Let's see if I can stretch this out. With being a buyer down here. This whole 4,000 a coin was pretty supportive area. You got many, many years of support. We've gotten down to this, just slightly above sub 4. I argue go a little lower here. Came right back up. Look at the volumes that came in during that period of time. As it came low, look at the volumes just spiked hard, right? When it started going up, the big vol came in. Notice what's going on here. The volumes are dropping off, like off the cliff. You'd think volumes would be just absolutely spiking, right? So what's that tell you from a volume standpoint? Nobody's stepping up to the plate en masse to buy at this point. Probably because the smart money thinks it's going down here. I could be wrong, and it could drop to here, but I'm just trying to tell you what I'm reading in the tea leaves here. Who knows? This area could hold. It could have a flash reaction to 28.5 and then start going back up to 40. That's entirely possible. But I don't think that's going to happen. Again, I could be wrong. And for those long, I hope I'm wrong. I really do. I hope I'm wrong and it goes back up. But there's some ominous stuff going on, and a lot of it has to do, at least with me, stupid lines here now. Oh, it's a flagging, but in all fairness, it's just a bear flag. It's been very quiet in crypto social media. I mean, almost eerily quiet, right? And you take this stuff all as a sign. So don't think it's going away. Love to be a buyer of the coinage somewhere in the 4 to 20 area after a decent basing pattern, right? Could be a while. Anyway, let's see what else. I don't know, for the question that's asked about the new EA, we are a beta test group of about 26 of us. Some are more plugged into others, and myself not as much as the others. But unlike a lot of the previous beta test groups, I've been paying particular attention to this one because I like what I see from the very beginning. And everything with me, as everybody should know, is all about low drawdown. You develop the best trading box to trade whatever. You walk through the door of Pershing Square Capital Manager, D.E. Shaw in New York, or Renaissance Capital. These are all big hedge funds. You showed them your box, and you showed them a 17 or higher drawdown. They'd kick you out the door. You wouldn't even make it past the first interview, right? And it's oversimplification. It doesn't necessarily work that way, but drawdown's everything. It's the bottom line. And if things can have low drawdown and cut risk quick, which I'm going to talk about in more detail in Orlando, that's really key. So with that being said, no other questions. Thank everybody for joining today. Always pay attention to the risk management. Spread the word. Don't spend all your money in one area. Be kind to each other. And just as a side note on the calendar, I think I don't know how to address this. So I'm doing the presentation from my office on Saturday. I get on a plane late Tuesday night. I'll be flying on the red eye on Wednesday. Tuesday, I think I'm pretty sure Tuesday I'll be able to broadcast 2 live. So essentially the next 2 sessions. Saturday is going to be a recording. So if you guys can remember that, I'll put all that in the Market Watch channel on Telegram if you need some further clarification. But everybody have a good week. May the trades be with you.